president of ITIF, and I'm here with three of my great colleagues from ITIF. So we're doing a little bit different panel. I don't think we've ever done a panel only with ITIFers. And the reason we're doing that now is because we've just completed an 18-month project generously funded by the Smith Richardson Foundation. So we want to thank them for the support, which without it, we wouldn't have been able to do this work. It's a project looking at what the effect is and trying to quantify the effect of Chinese innovation mercantilist policies, not so much on jobs or output, but really on innovation in the rest of the world. And want to jump right into it, but let me just introduce my three colleagues first, and then I'll make some opening remarks. So Nigel Corey is the head of policy for digital trade policy, and has former experience in the Australian government. Stephen Ezell is a senior analyst and vice president of ITIF, and leads our trade and innovation policy work. And David Hart leads ITIF's Center for Clean Energy Innovation and is also a professor at George Mason University. So let me just stipulate before getting into some of the actual details. If you don't agree with this, then you're not going to agree with really anything that we're saying on this. So let me just stipulate what we go into this analysis with. The first is that while China is engaged in some legitimate and fair and open and free trade practices, much of what they do is not that. It's basically mercantilist, unfair practice. And again, I'm saying not all of it is that, but enough of it is that suggests that there could be negative implications. A lot of that focus has been on jobs. Looking at David Otter's work, for example, as well as our work on the loss of manufacturing jobs from China. There's lots of analysis that says, okay, the Chinese impact has been on jobs, but nobody really has focused in depth. I mean, there have been some scholarly work on that, but much less in the think tank world on the effect of Chinese policies on innovation around the rest of the world. And let me, if we can pop up the first slide. So this is important because a lot of Chinese policies are not, if you will, legitimate OECD policies to spur innovation like R&D tax credits or funding for STEM education, government procurement related to innovation. Those are all great policies, and most governments have them because they want to spur innovation domestically. So it's not like there's anything wrong with those kinds of policies. It's when you design those policies in a way that is highly distortive, as China has done. For example, forced technology transfer, intellectual property theft, massive late-stage subsidies, not early-stage R&D subsidies, but late-stage production subsidies, R&D tax incentives that only apply or are more favorable for Chinese firms, closed markets. These are all problems that go way, way beyond just sort of normal practice. So just logic alone would suggest that China's policies have harmed global innovation because most of Chinese firms, even today, are fairly far from the global innovation frontier. They're playing catch up. And so when they gain market share, almost always in innovation industries or advanced technology industries, these Chinese firms are taking market share away from firms that are farther along the global innovation frontier. They're doing more R&D, they're patenting more, they're bringing more and better products to market. So that's the real issue, is how much have these Chinese policies, these unfair policies, taken market share away from global innovation leaders. By taking market share away, you do two things. You have fewer less output in innovative companies. But the second thing you do is you reduce the incentives for these companies at the global frontier, US companies, European, Japanese, and others. You reduce their incentives to keep investing in innovation and R&D because now their returns are going to be less and the competition greater. So when you look at economic theory, there's really sort of two thoughts on that, two approaches. Well, This increased competition from China could force the other competitors to, quote, pedal faster. They now face steeper competition. They're going to work even harder. It's really, at one level, not a very convincing theory just on its face. Already these companies face intense competition, whether it's a European company facing competition from other companies in Europe, the US, Canada, Korea, Japan. They already face competition. They're pedaling as fast as they can. The second effect, as I said, is it could eat into revenues and limit the ability of affected firms to reinvest in R&D and advanced production. The first report we did in this series was a thorough literature review of pretty much every study that was done on the effect of Chinese policies, unfair policies, on innovation in other countries. So Korea, Japan, Europe, Canada, the US, and the like. And pretty much every single study showed, there were a couple that didn't, although one of those studies was later rebutted by a later study that critiqued their methodology, I think, very effectively. But I'll just give you one example of that. David Otter, Dorn, Hansen, Pisano, and Xu, mostly from MIT, they did a thorough econometric analysis, and they found, quote, they document a robust negative impact of rising Chinese competition on firm level and technology class level patent production. Accompanying this fall of innovation, global employment, sales, profitability, and R&D expenditures all declined within these trade-exposed firms. Now, we found the same thing when we did in-depth case studies. So we looked at 5 key sectors of the Chinese advanced technology economy. Telecom equipment, which I'll talk about just in a moment. High-speed rail, which Nigel will talk about. Solar panels, David Hart. Biopharmaceuticals, which I had written, but we won't discuss it today for time purposes. And semiconductors, which Stephen Azell conducted. There's the short story on telecom is that Huawei and ZTE simply would not exist. They just would not exist, or if they did, they would be minor firms without these Chinese policies. Now, Huawei is the dominant player in the 5G market. They're the dominant telecom equipment player. But even Mr. Ren, Huawei founder, admitted that without Beijing's policies of protecting Chinese companies from foreign competition, that Huawei would, quote, no longer exist. They are, and you can go to the next slide, please. Now you can say, well, why does that matter? Hey, maybe the Chinese put a lot of money into Huawei and they're now the innovation leader. In fact, when you look at a number of innovation metrics like 5G patents, 5G standards contributions, what you find is that Huawei is lower than some of the leaders. They're certainly lower than Nokia. They're lower than Ericsson on a lot of these. And they're lower than Samsung, which we didn't include in this slide. Next slide, please. So if you put all that together and you say, okay, take away the Huawei market share and assign it to Ericsson and Nokia alone, what would the world look like if you assumed that they were patenting and doing R&D and standards at the same rate they're doing now? You'd find that there'd be 20% more R&D, there'd be more standards, about 18% more standards, and about 70% more trade standards essential patents. I think you go to the next slide, which may be, okay. So the point, I think, of all of this is that what you see here is that the conversation now about Huawei being the big dominant leader, they're doing all this R&D, that's true. But without a whole set of policies, including the Chinese government paying for the development of the first Huawei switch, making it mandatory to get market access there for telecom companies like Ericsson, like Lucent and others to give their technology to Chinese companies, including Huawei. Massive subsidies, both for production. Wall Street Journal found that Huawei received over $75 billion in government subsidies, and then massive export subsidies. You just simply would not have seen the pattern we see today, and you would have seen bigger market share in more innovative telecom companies. So with that, I'll turn it over to Nigel for a discussion of the effect on high-speed rail. Nigel, you're on mute.
Thanks, Rob. Sydney, if you can bring up the next slide. Thanks for that, Rob. As he described, I took a deep dive into high-speed rail. And it's an interesting case that really clearly highlights the impact of Chinese innovation mercantilism, in that high-speed rail in and of itself is not as strategic as, say, semiconductors in their broad application, but it's really symbolic of tech leadership, which China saw that Japan and European firms had, and it wanted to unfairly seize. And so when I'm talking about high-speed trains, I'm obviously talking about trains that go sort of above 150 or 200 miles an hour. And so they're a smaller part of the market. But this sector was also important to look at because it encompassed the broader rail sector, because there's a complete sort of industrial base that goes into supporting this part of the market. And it also is the highest value, most innovation intensive part of the market. It's extremely complex and takes a long time to master. And it's innovation driven in that these companies are not focused on producing current products and systems more cheaply. They're focused on developing the next generation of faster, quieter, smoother, more environmentally efficient products. And so these firms, mainly foreign firms, continue to invest in the many underlying technologies that go into both wheel-based sort of fast trains, but also the ever-elusive potential of maglev, sort of levitating trains. And so, but when we're talking about innovation in this sector, we also are talking about the bridges, the tunnels, the track and power supply, the train and network management, all the things that go into it. And I just start by highlighting this because all of this innovation is at risk due to Chinese innovation mercantilism. Now, China is the home of the world's largest high-speed rail market. It's home to over 2/3 of the world's high-speed rail market. It operates the most train services, and it's still continuing to build. So it plays a unique and oversized role in the global high-speed rail market. And when it decided to take this track, it had all of the financial resources to pursue sort of high-speed rail development in a free and fair manner. But instead, it chose a very purposefully sort of mercantilist approach. Next slide. Thank you, Sydney. In that Chinese support for high-speed rail goes far beyond generally supportive industrial policies in other countries. And it's been massive in its size and scale. And it's particularly important because the high-speed rail market is characterized by a few large projects around the world at any one time. And so each of these projects holds much, much broader significance to the few firms that are involved in this sector. And so if you have a firm in there that's unfairly supported and competing in this sector, seizing market share unfairly, it has a disproportionate impact on the broader sector's ability to innovate in detracting revenue and market share from firms that are genuinely more innovative. And so this sort of leads to sort of a two-pronged reaction, which I'll detail in the recommendations. But I'll first walk you through sort of the key findings of my study into this sector. Next slide. Thank you, Sydney. Basically, what we have to realize is that China sort of used all of its tools in its mercantilist toolbox here. First, its forced merger between China Southern and China Northern Rail to create the Goliath of the rail sector, as this graph shows. It then directed huge amounts of subsidies towards it. It ensured that forced technology transfers were embedded within each and every contract that they issued. It set up sort of a whole research apparatus to support CRRC, which is China's national champion in regards to high-speed rail, to support it every which way it could. And again, it could have done this. It had all of the means to do this fairly in working with the leading foreign high-speed rail firms, which are namely Alstom and Bombardier, of which the former acquired the latter recently, and Siemens and Kawasaki, and to a lesser degree, Hyundai. And so to help CRC grow in size, but also capabilities, it used all of these unfair tools. And I'll just briefly talk about forced technology transfers. which were central to the development of CRC's capabilities, and they continue to use it today. Basically, during the earlier stages, in the early 2000s, China enacted within key contracts the compulsion for foreign firms to hand over technology to local partners as part of forced joint ventures, and that they had to abide by this. And so foreign companies were faced with the conundrum of, do they engage in China or not? But if they stayed out, they risked one of their competitors going in and seizing the opportunity. But what they obviously didn't realize was how quickly CRC and the other Chinese firms would sort of use their technology and adapt, and how quickly China would basically gradually expand its restrictions to force them out of the market. And essentially since 2010 or 2011, foreign firms have been effectively prohibited from China's high-speed rail market. Next slide. And so what you see here is the creation of their national champion across all sectors, which provides them the ability to engage and compete in a way that few foreign firms are capable of doing so. The next slide, please. So in turning to the impact, we use publicly available data at the country level, at the firm level, and at the technology level to assess how does CRC stack up against leading providers. And we largely had to disregard Chinese statistics because there's so many sort of non-innovation and financial related incentives that goes into it. And what we essentially found is that, you can go to the next slide, thanks, Sydney, is that CRC sort of has been growing in capabilities. And as it's grown and sees market share at home, it's expanded overseas. And so this map shows you just how sort of persistent and broad their expansion's been, in that they're not just satisfied with dominating the Chinese market at home, but essentially exporting and using their unfair advantages of a protected home market to seize market share abroad. Next slide. So CRC's main weapon as it goes global is cheap state-backed financing. And this allows it to underbid its competitors by 20 to 30%. And we see this here in the United States and Europe and elsewhere around the world. And so this is a critical component in them being able to seize market share. And it's also a critical counterpoint for policymakers to target as they seek to block this type of unfair competition. Next slide. And so what this shows, though, in terms of assessing the comparative innovative capabilities, is that since CRC's sort of emergence, when it was merged in 2015, it's gradually been growing its R&D capabilities and its foreign acquisitions and its pursuit of foreign technology and know-how. And while it's still sort of below sort of the market leader here, Siemens, it's doing, I highly suspect that this figure here undercounts the true extent of their R&D, given the various ways that China supports R&D in the sector. Next slide. And so what we see here is that even just CRC and one other Chinese firm in aggregate are spending 2/3 of the R&D that you see from all of the other foreign firms combined. And so that's just gives you an indication of the size and scale of their CRC, sort of like the R&D impact they're having. Next slide, please. And so what we found across the board was that while Chinese firms have lots of domestic patents in China, that they're essentially sort of absent from patent holding statistics in the United States and Europe, showing they actually don't hold true sort of high value patents. But that they're committing a lot of resources and attention and effort to try and close that gap essentially. And I highly suspect we'll see them continue to do that over the coming years. Next slide, please. And so this is just a slide to show you just how far behind they are, but behind the market leaders at the moment in comparison to Alstom. Next slide, please. And so again, within our assessment, we looked at the impact that this diversion of market revenue had from, in terms of unfair market share, in what we think it would have resulted in terms of patents by other foreign firms who otherwise would have been able to invest it in cutting edge new innovation. And that it showed that, next slide, thanks Sydney, that sort of Alstom and Bombardier and Siemens would have produced like 150 to 200% new patents in their area if the market had been fair. Next slide, please. And so the recommendations here are twofold: domestic and international, essentially to block Chinese acquisitions and involvement in domestic procurement markets, and then sort of internationally, stop World Bank funding for Chinese rail projects, support the expansion of export financing for rail firms to engage in overseas projects, to support the development of good standards for high-speed rail, and also to increase the range and size of R&D supportive measures to genuine innovation focused firms. And I'll end it with that and hand it over to Stephen.
Well, thank you very much, Nigel. And you can go to the next slide, Cindy. So my contribution to this series is a report called Moore's Law Under Attack: The Impact of China's Policies on Global Semiconductor Innovation. And the report notes that China has rolled out an aggressive series of strategies across its national IC, or integrated circuit plan, as well as the Made in China 2025 strategy, seeking to make China a global leader in semiconductor innovation and production. The national IC plan in particular has announced $170 billion worth of investments contributed by Chinese federal, provincial, and city governments in an effort both to stand up new competitive Chinese semiconductor firms as well as to acquire ones in international markets. For instance, funding from the National IC Plan and the province of Hubei literally stood up with $24 billion of subsidies the Chinese memory semiconductor firm YMTC. Likewise, China has used some of these funds to go out and try and acquire firms in international markets, such as a proposed $23 billion acquisition of Micron, other efforts to purchase firms like Lattice Semiconductor or Axtron. In fact, this all fits into what one consultancy found as of December 2020 was a Chinese government-guided strategic technology investment fund of $610 billion to either stand up or to acquire leading-edge technology companies in advanced markets. It's also important to note that China's policies in this sector are oriented around import substitution and autarky. In fact, the National IC Plan called for, quote, reducing foreign imports of semiconductors in half by 2025 and to ideally eliminate them entirely by 2030. The plan wants at least 70% domestic production of semiconductors used in Chinese products by 2027. And as my colleagues have indicated, China is trying to compete in this sector through a wide range of innovation mercantilist practices, such as massive subsidization of state-owned enterprises, forced IP or technology transfers and conditional market access, IP theft, standards manipulation, preferential tax policies, et cetera. And the report comprehensively documents those innovation mercantilist policies. Next slide. So there's evidence that some of these strategies have started to pay off. China now leads the world in value added produced in the global semiconductor industry. Its output at $120 billion in 2016, the latest year in which internationally comparable NSF data was available for this study, was actually double America's output of $56 billion. And in fact, from 2001 to 2016, China's share of global semiconductor value added actually grew almost fourfold, from 8 to 31%, while the US share fell from 28 to 22%. Likewise, from 2005 to 2019, the value of China's semiconductor exports increased by 400%, while US export levels were flat over that period. Next slide, please. Not surprisingly, China's semiconductor value added and exports are increasing because the country's share of global semiconductor fabrication capacity is increasing. In fact, as this slide shows, from 2007 to 2021, China's global share of fab production increased nearly 15%. And by 2030, the country is forecast to have 24% global share of semiconductor fabrication capacity. The nation now actually has 30 new fabs in construction or on the drawing board. Now, in contrast, the US share of global semiconductor fabrication capacity actually declined from 37% in 1990 to 12% today. And this, of course, has been a key impetus for the $52 billion CHIPS package that was recently passed by the US Senate and the US Innovation and Competitiveness Act. The CHIPS Act provides funds for both increased semiconductor R&D and innovation research in the United States, as well as a set of grants to encourage and level the playing field for the types of incentive packages that nations across the world offer to attract semiconductor production. Very important policy that we call upon the House and the Biden administration to pass. Next slide, please. Now, where is the funding for this massive expansion of semiconductor fabrication capacity in China coming from? And the answer is the Chinese government. As the OECD writes in its report, Measuring Distortions in International Markets, the semiconductor value chain, quote, there notably appears to be a direct connection between equity injections by China's government and the construction of semiconductor fabs in the country. And as this slide shows, state subsidies as a percentage of revenue for Chinese semiconductor firms absolutely dwarfs and is an order of magnitude beyond what Taiwanese, American, or Korean companies enjoy. In fact, for the China's firm SMIC, state subsidies accounted for 40% of the firm's revenues from 2014 to 2018, 30% for Xinhua Unigroup, and over 25% for Huahuang. And as the OECD found in the study, which looked at 21 international semiconductor firms from 2014 to 2018, it said, quote, government support through below market equity appears to be particularly large in the semiconductor industry and concentrated principally in just one jurisdiction. In fact, the report found that Chinese firms together received 86% of below market equity injections in the sector over that time period. Next slide, please. And as Rob alluded to, the reality is that despite this funding, Chinese firms in the sector are far from the leading edge in the global frontier. As you see here, a chart that looks at which countries lead in semiconductor logic and memory chip manufacturing. In logic, it's firms like Intel, Samsung, and TSMC that are at the cutting edge at that 5-7 nanometer production. SMIC at the 14 nanometer levels, far behind. The same in memory. Changxin Memory Technologies, Nancy Memory Technologies at about 20 to 25 nanometer process nodes are not nearly as innovative as the leaders in the world in Micron, Samsung, and Hynix, SK Hynix. And this matters. Because the reality is that every $1 of revenues that a Chinese firm captures in this sector is $1 taken away from the more innovative companies. And that matters more when in semiconductors, we're dealing with really, maybe aside from biotech and a COVID-19 pandemic, but the world's most important industry and the world's most R&D and capital intensive industry. It takes $20 billion to construct a new fab. The industry invests about 20% of its sales in R&D annually. In fact, there's a strong positive correlation of 0.89 between semiconductor firm revenues in one year and their R&D expenditures in the following year. So when profits are being taken away from the more innovative companies, it hamstrings their ability to invest in the next generation of innovation. And that matters because it's the profit from the 10 nanometer line that begets the funds to invest in the 7 nanometer, the 5 nanometer, and the 3 nanometer. And if that process gets disrupted, then innovation in the sector becomes stillborn. Next slide, please. And the reality is that while globally the industry invests close to 20% of its sales in R&D every year, Chinese firms invest a fraction of that. In fact, Chinese semiconductor firms are less than 1/2 R&D intensive as US firms. They're just about 40% as R&D intensive as European firms. And they also patent at far lower rates. In fact, when you look at both Chinese firms' share of global patent grants and US patent grants, as we see here, Chinese firms in the sector receive about 1/6 level of patents as American firms do. And our report finds that as a consequence of China's mercantilist practices in the sector, there's about about 5,000, essentially, in the absence of China's policies here, we would expect more than 5,000 additional US patents in the industry annually than is otherwise the case, because these unfair practices are denuding the ability to earn profits and reinvest in innovation. So in conclusion, with the semiconductor industry, here we have a case study of a sector where China's industrial policies are being implemented in ways that are fundamentally not consonant with its WTO commitments, and in which the influence of these practices have had a very deleterious effect on the capacity of the sector to innovate globally. The policy recommendations we would have to deal with this mirror many of the ones Nigel has just introduced. We released a report last year called An Allied Approach to Semiconductor Competitiveness that laid out a number of strategies where like-minded nations can work together to collectively advance our semiconductor ecosystem with policies like collaborative technology development, technology protection. But one thing we need to do in particular is to work at the World Trade Organization to better define the process of subsidies, to insist upon better notification of the subsidies that countries are putting in place, and to ensure that when these practices are being implemented by a country like China, then like-minded nations come together at the WTO to bring cases to contest those types of aggressive and abnormal state subsidies that really disrupt the sector. So with that, thank you, and I will turn it over to David for a discussion of energy. David, you're on mute.
Mute. David, you're on mute.
I'm sorry about that. Thank you, Rob, but I'll go quickly by that. So thanks, Rob. So the next slide, please. So I think most people are familiar with this story, which shows the incredible growth of the solar PV capacity in the world over the last 20 years, to where it's really the dominant technology being installed today. Next slide, please. And I think a lot of people are also familiar with this story, which shows the rise of China as the dominant producer of PV systems. So at the beginning of this time period, right before 2000, the US, Japan, and Europe, shown in the green, red, and blue here, were the dominant producers. And by the end, as that market growth occurred, China, which is the orange bar here, has taken over. I want to take a closer look at that key period in the middle between 2006 and 2013, when China kind of rose to prominence. Next slide, please. So my story in that period is divided into 3 phases. In the first phase, there isn't a lot of government interest. The industry was really developed by Chinese students who returned from Western countries, especially Australia, and supported by funding that came to some extent from the United States and other Western investors. It was a purchaser of capital goods, especially from Germany. So German technology was installed in factories that started up PV production in China. And that's how the industry got started. The second phase, from 2007 to 2009, still relatively little interest from Beijing. Few people there had grasped the potential of PV, but entrepreneurs, many of them, as I mentioned previously, foreign students, found support from local and provincial governments. And this industry was entirely developed for export at that time. 2 things changed in this period. First, the potential of this industry begins to become clear, and Beijing begins to recognize its potential. And the second is you have the financial crisis around the world. This crimps capital availability, and especially capital-intensive industries like solar PV and manufacturing get hurt by that. And it was a riskier business then than it is now, so that's worth bearing in mind. And so that sets up the third phase in this crucial period, and that's when Beijing steps in around 2010, and it provides support for producers, especially backstopping financial capital access by these producers, something like $40 billion or more in loans or loan guarantees provided by state-owned banks, and then creating a big and protected domestic market in China, which is now the largest, becomes the largest consumer of solar PV. So the bottom line in this period is you get this incredible growth of Chinese producers with almost no profits throughout the period. The next slide, please. So this slide shows the outcome of this. The orange line, dotted line here shows exits from the industry, and you can see it peaks right after that period, 2010, 2011, 2012, 2013. Chinese producers wipe out the rest of the world. So there's not only a shift in where production is being done, but who is doing the producing. Next slide, please. So one interpretation of this period, the dominant one, is that this was China's, quote, gift to the world. Production subsidies benefited consumers in China, but they also benefited consumers in the US, Europe, and elsewhere. So that's where I get the title of my paper, and this is true. This famous graph shows how prices drop as production grows. And the last segment from 2008 to 2018, LR stands for learning rate. That means about 35 to, as production doubles, prices per unit go down about 35 to 40%. So the learning rate is 35 to 40%. And there were multiple doublings in that period. So there was this incredible virtuous cycle between cost reduction and market growth, and that was partly subsidized by the Chinese government. Next slide, please. But hidden in this graph is another trend. So if we look more carefully at the learning rate, we can break it up into different technologies, and I show two of them here. The dominant technology is the top line, the black line, that's silicon PV cells. And the bottom line is cadmium telluride. That's an alternative type of PV technology. And the fact that these two lines are parallel to one another shows that for any given price, right, so the y-axis is price, for any given price, you would need a lot more production, or the other way around, for any given level of production, cadmium telluride is going to have a lower price. That's cumulative production. So the next slide, please. And there was a time, right at the crucial moment in my period, when it looked like cadmium telluride was going to become a major player in this market. So it goes up to 10% of global market share in 2009. That's the light blue band here. And it was starting to challenge silicon as the dominant technology. But by 2017, it goes down again to 5%. And almost all the companies in this business were wiped out. A lot of those exits that you saw on the previous slide were thin film technology, and cadmium telluride is a kind of thin film technology, those companies. Only one survived, the last major US headquartered PV manufacturer, that's First Solar. So the next slide, please. So here's what happened. So this is the same graph I showed you earlier, but with the addition of time. And what I've done is link the points in time that are at in the same year. So the slope of the blue lines that link these points shows you which technology is cheaper. So in 2002, the line is like this. That means that the silicon crystalline technology is cheaper. So I've linked the 2002 point on the black line with the 2002 point on the red line. But as time passes, you can see by 2008, actually, the line is sloping upwards so that the PV from cadmium telluride is actually cheaper per unit than silicon crystalline. But then as those subsidies kicked in, you can see in 2011, it's roughly flat, which means they're roughly equivalent in price. And by 2018, the line is sloping downwards again. That means that silicon PV is cheaper. And even though at any given level of production, it might be cheaper to have cadmium telluride, the levels of production of silicon PV is just so great that they've been able to ride down that learning curve much more quickly. The next slide, please. So in the paper, I developed some scenarios, and I argue that it wouldn't have taken that much to change the slope of that line. And I won't run through these now. I'd welcome any comments people have if they have a chance to read the paper. But the bottom line is there in that quote. The biggest feel-good story of energy in the past decade, that is the solar PV story, might have felt even better if these alternative technologies had a chance to develop. And the reason they didn't was because China invested so much in the dominant technology. So there's a whole a host of policy implications here. There's an R&D agenda, there's a trade and diplomacy agenda, a manufacturing agenda. The next slide, please. And the solar story isn't done, but I think what's more important are potential future technologies that are coming down the line, where it's possible that some of the same policies might be enacted and we could have similar outcomes. So I've listed a few here. And with that, I'm going to conclude, and thanks for listening, and I'll kick it back to Rob. Now it's your turn, Rob.
What's the wrong with these technologies? Okay, thanks everybody. That was great. If folks have questions, feel free to just put them into the chat box there, and we can respond to them. While you're doing that and thinking about that, I just want to make one point that related to what David said. And with true, it's all of these technologies. We meaning the non-Chinese world, we get some benefits of this. There's no question about that. You know, they're going to sell us cheaper trains. That's why transit systems in the U.S. are buying these trains. We get potentially cheaper solar panels. I mean, semiconductors. We certainly get cheaper solar panels. But I think that's the wrong way to look at it. If we wanted to save money, we should just ban all R&D. No more R&D. That, if you took out R&D, everything would be cheaper because companies wouldn't be spending money on it. So we'd all save money. We'd save taxes if the government didn't fund R&D.
There's also a lock-in effect that we get locked in at a lower rate of technological innovation. And when you're dealing with ecosystems like solar panels, where there's not a replacement cycle every 5 to 10 years, it means that the solar panels sitting atop America's houses and buildings that were made in China at an inferior level of technology are now kind of blocking in the world at a lower level of output and technological innovation that would otherwise be the case in the absence of these unfair trade practices.
Sure, absolutely. And I think that really gets to a lot of the discussion here is really how much do you value innovation? And I know, for example, in climate, we value innovation a lot. That's what David's team is really focused on, is how do we accelerate the pace of clean energy innovation? Because in our view, other measures are important and are needed, but you have to have innovation. And so I think, the overall part of this approach or this project we were doing is really to try to get policymakers around the world to put innovation at a higher level of value. Because right now, if you think about how do we think about global trade, how do we think about interactions, economic interactions between countries, they're really based upon the post-World War II allocative efficiency. So this is kind of Ricardian comparative advantage. The Portuguese sell wine to the British, and the British sell textiles and don't have tariffs, and everybody's better off. But that framework, while it was important in a commodity-based industrial world, it really is inadequate to deal with and adequately govern an innovation-based world as we've moved into today. And that goes to Stephen's point of the importance of really getting the WTO to put innovation really at the heart of what they're doing and to think about these issues, whether it's whether data flows that Nigel works on, or a lot of these other areas. It's just striking how we don't really take innovation seriously here.
If I could just add to that, I think it's really important for the Western countries to get together, and even before the WTO moves, I think we can align with them. That's the burden of Stephen's paper on semiconductor manufacturing. It's clear in the climate and clean tech world that we have some interests in common, and I think hopefully the president is going to pursue some of those in the coming week.
We could hope that would be good. I think a lot of this issue also is countries are, there's a monopsony issue. There's so many countries that are afraid of, alienating China. I have to give a lot of kudos to Nigel's home country. Those people have stood up to Chinese bullying, and I give them so much credit. And we should be aligned with the Australians on that. And we are to some extent, but not enough. And other countries certainly are keeping their head in the sand. So it's going to take some courage from countries to do that.
And I think just to follow on from that and pick up one of the questions in the chat in terms of we talk and talk with little action, we talk about grand solutions, what can we actually do? I think what we've seen in the last 5 or 10 years is a gradual sea change in perspectives as to China's impact on high-tech sectors. My home country, Australia, and talking about sort of ICT, obviously the focus on semiconductors, and then increasingly in Europe about high-speed rail as well. And so there is some chance for a change of context here and a change of consideration as to policymakers taking a broader look at the impact of China. And then in my particular sector, it's quite interesting to Rob's first point about explicitly valuing innovation and including it sort of as a defining criteria in public procurement to filter out procurement bids from Chinese firms that are obviously based purely on unfair sort of state-supported price. So including innovation-related criteria about performance and whatnot is one way there to filter out this unfair competition, and sort of is one demonstration that Europe's actually taking some concrete action in regards to what China's doing in the high-speed rail space.
Yeah, I would just clarify Nigel's point. Is we're not saying all Chinese firms are engaged in this, but there are certainly some where it's clear evidence, and then those are the firms that we should be focused on. There's another question here. We all stand on the shoulders of giants. Could decoupling from China hurt U.S.? Sure.
Well, you know, Rob, on that point, it's also important to recognize that when we look at the semiconductor industry, 36% of U.S. semiconductor industry sales are in China. So there is a deeply integrated global value chains in this sector. China is an important market, and ideally, we want to craft competition in these global technology industries in accordance with the rules that were set forth in the World Trade Organization, right? And we'll have a report coming out in a few weeks called False Promises 2, but on December 11th, 2021 will be the 20th year anniversary of China's membership in the World Trade Organization. And this report will find that nearly 20 years on, as we've documented here, China has consistently failed to fully and comprehensively adhere to the commitments it's made as part of that organization. That's why it's important that our strategy must be twofold. It must be to enroll like-minded allies to put pressure on China to adhere to its WTO rules so that we can have a properly working global marketplace in these technology industries. You know, some people say the U.S. should just run faster. We need to run faster. We need to invest in R&D and innovation. That's what CHIPS is. It's what the U.S. Innovation and Competitiveness is about. But those who think that running faster alone is going to solve the problem, in my opinion, are misguided. Yeah,
and that's a major reason why we oppose the Trump blocks of chip exports to China. They were only shooting ourselves in the foot. So it's not so much decoupling with China, as Stephen said, it's getting China to play by the rules, and then innovation prospers globally. There's a question here about how do you account for the fact that U.S. and China now have become the largest source of jointly authored top-tier journal articles across STEM fields? I can answer that by simply saying China has all of these measures that we used in this report were on a per GDP, per capita, per revenue basis. China has a boatload of scientists now, and of course they're going to be publishing those. They also have large incentives in the system to jointly publish with U.S. authors. And finally, science is different than innovation. There's no question that the Chinese science system is improving, and I give them all the credit in the world for that. That's what you should be doing. In fact, China should be doing more of that, frankly. So great for them, great for the world. That's a kind of win-win policy that we can all support. This isn't a black and white. Everything the Chinese government does is bad for innovation. Everything we do is good. Chinese STEM education and basic science and journal articles with us are great. But that's very different than what David and Nigel and Stephen were talking about. David,
a lot of that
thoughts on that?
is also accounted for by the fact that so many Chinese students have come here. contributed a lot to our innovation system, and we maintain those ties when they go home, and that's a really important value for the world and for us.
You know, in fact, 81% of full-time graduate students right now in U.S. electrical engineering programs and 79% in computer science are international students. And of those, 70% in total are from China or India. So that's certainly an important part of our capacity to innovate in this sector. But it does also mean that the U.S. needs to tend to its own domestic STEM talent pipeline, and also that ensuring that those students can stay and work here in the United States after they graduate becomes vitally important to our semiconductor innovation ecosystem.
So, Stephen, this question probably I'll throw it over to you. Isn't this, and I think, and saying government telecom funding of Chinese companies like Huawei, isn't it similar to the funding U.S. companies received early in the computer development phase that gave U.S. companies like Intel market leadership?
Well, I think 40 years ago, federal funding for semiconductor R&D was more than double the level of private sector funding. However, by 2019, U.S. private sector investment of about $40 billion in semiconductor R&D was 23 times greater than the federal government's level of investment. So actually, we do have a situation here where the federal government is actually underinvesting in kind of the basic R&D needed to advance to the next generation of technology development in the semiconductor industry. And that's a gap we have. Certainly it's an industry where effective public-private partnerships over time have been vitally important to the success of the sector. Cimatech in the 1980s was wildly successful in terms of restoring lost competitiveness to some degree that we experienced in the sector. Today, we have initiatives such as the Electronics Resurgence Initiative and JUMP. The support for federal funding of kind of both the basic and the applied R&D that our companies will need to break through to that next level of semiconductor innovation becomes incredibly important. The cost to advance to each next level process node to move from 7 to 5 to 3 to 2 nanometers, that doubles each time. So as the cost gets ever greater, finding effective public-private partnerships and building technology roadmaps collaboratively to deal with that challenge becomes vitally important.
Yeah, absolutely agree. I would also, though, make I think a point about, if you read the early history of Silicon Valley, there's a great biography of Gordon Moore that came out a couple of years ago, fantastic biography. It's very clear that the role of the government was very prescribed. The major role of the government was for the Air Force to buy chips that nobody else wanted to buy because they were so expensive. Air Force cost was no barrier to the Air Force. They just wanted precision and durability and all. And that then gave these companies a little bit more money to invest in the next round of innovation. That's very different than picking national champions and providing them with massive subsidies. The same thing with Lucent, which in 2000 was the world leader in telecom equipment. A lot of that funding, a lot of that innovation was due to Bell Labs. And I wrote a piece last year called Who Lost Lucent? And yeah, there was some government funding for Bell Labs, but it really was very, very targeted to defense needs. Most of what Lucent did in terms of its ability to become the world leader was its own internally developed R&D. So again, that goes back to this broader point. One of the, I think, complaints about this kind of analysis is, well, everybody does this. Yeah, everybody does. If you don't do a technology policy, you're pretty lame. So yeah, most countries do technology policies, but it's the gradation of it. It's the extent of how distortive it is. It's where it is in the process. Is it early on? Is it late stage? And that's really what we're objecting to with some of these Chinese policies. Another question here. How much of China getting ahead of the U.S. is because of our own misguided policies in the past? That's a super important question because it's clearly not all China, no question about that. David, you want to maybe take a crack at that?
Yeah, I guess in my sector, I wouldn't quite characterize it that way, but I think more broadly, and maybe Stephen can speak to this, the terms on which China came into the WTO haven't been enforced. I don't think the economics profession took the potential impacts of that accession seriously enough. So to me, that might be the biggest failure. And then on the flip side, we failed to invest. I mean, this Passage of the Competitiveness and Innovation Act by the Senate is an important step in the right direction. But the U.S. has underinvested in its own capabilities for quite a long period of time. So I think in both of those ways, I think that's a fair point, that our policy failures have contributed to the development of this situation.
Yeah, I think another one there would be just a lack of understanding or belief among policymakers and economists of the importance of manufacturing to a modern economy. Rob and I wrote a book called Innovation in Economics some years back, where we quote the leader of a major economics think tank in Washington, who said, really, the U.S. could lose all of its manufacturing and be totally fine. And there are stories of companies being happy when they were getting rid of assets because it would increase their return on net assets. So I think understanding that we can't have an innovate there, make there environment, but it's got to be innovate here and make here is important.
Yeah. So another question is, by the way, I mean, I think that's another way this whole argument gets framed in a sort of inappropriate way. It's kind of this Manichaean argument. It's either, we should run faster or it's all China. It clearly is a combination of factors. If this were a multivariate equation, there'd be a bunch of factors with high betas. Clearly, part of this is our own failure. I mean, we used to invest significant amounts of federal R&D in our universities and in our labs, and we're investing much, much less of that now. And that has contributed to the U.S. loss. So it's not as if China is the thing, but it certainly has played a role, and in particular, a role on global innovation. So there's an interesting question. Doesn't this picture change as China moves from a factory economy to an innovation economy? Is this dynamic going to happen in the future, I guess maybe is a way to think about it.
Yeah, it gets worse.
Yep.
No, that's a good point, because, as China is, for example, in the biotech report, which we didn't talk about, here's a technology area where the U.S., it's almost like telecom back in 2000. We are the unalloyed leader, particularly compared to China when it comes to biotechnology and pharmaceutical innovation generally. But they're doing some interesting things. They're catching up, and much of their policy regime is completely illegitimate. Not all of it, but much of it. Weak IP protection, short-term patents for drugs, forced tech transfer, a whole set of things really trying to take advantage of their ability to have a very large and growing pharma market. So, I think there's a real potential that in 15 years, we're going to have a report or a study that says, how did we lose U.S. biotech? I think that's a pretty legitimate question to ask ourselves right now. Why should we just assume that somehow we lost rail, we lost solar, we lost telecom equipment, semis were not quite, haven't lost it all. We're working on that one. And I don't see why we shouldn't think that's not possible in the future.
The other aspect of that equation, which is slightly beyond today's remit of discussion, but is that as we lose comparative economic wherewithal, so over time we'll lose comparative national security wherewithal, and that becomes a big geopolitical threat.
So maybe last question for David. I wish we had more time, but I promised everybody we'd done it one. David, how do we reconcile the need to collaborate on climate change with the need to protect climate tech innovation from China, or maybe another way to put it, to advance climate tech innovation globally?
Yeah, I think we're going to have to do both. Obviously, climate is a huge problem, and there are aspects which are obviously areas for cooperation, assessing the extent of climate change, anticipating, what it might be in the future and how do we build resilience to it. But some of the solutions are going to be competitive, and that's going to help drive innovation. And we're going to need to develop a global trade and investment regime that is innovation friendly. And I do worry that we might move toward one where we, as Stephen alluded to earlier, we can lock in suboptimal solutions. And I do think that's a big challenge on the horizon. And we should be encouraging competition in a number of industries. And I fear that they may follow in the footsteps of solar PV.
So I'll just quickly answer one last question here in 1 minute, which was, what else can we do besides the WTO? And I think one thing we can do, and I hopefully President Biden will talk about this. There's a talk about a D10, a democracy 10, or the other different kinds of bilaterals or multilaterals. One thing we could do would be we could have a global regime where we identify Chinese companies that have clearly gained advantage in unfair ways, and just simply say that we're not going to be importing their goods, particularly for public procurement. You see cities around the U.S. buying these trains from China, and I understand why they're doing it. They're like any other consumer. They want the best deal. The last thing in the world they're interested in is U.S. jobs and even beyond that, global innovation. They don't care, nor should they. But there should be a system in which we make them care. And it's the same thing, frankly, with government procurement and other things. You know, we have a provision, we have a policy in the International Trade Administration where imports based upon IP theft can be blocked. We need that system globally, or at least among the D10 and our other allies, where we basically send a clear message to China. This is not going to benefit you. You won't have unalloyed access to our markets if you've gained competitive advantage this way. If you've gained it in a pretty legitimate way, 80% legitimate, sure, okay. But if it's 80% illegitimate, no, you're not going to be able to do it. Any last thoughts before we close this?
Well, we also need to build up market opportunities in like-minded nations. When companies feel, well, we have to sell into China because a certain, percent of market share, we need to build up the technology ecosystem in countries like India, so our companies are able to sell into those types of markets of friendlier countries. And that's why we need trade agreements like the CPTPP, which I would call upon the Biden administration to rejoin.
Absolutely. Yeah. Okay. Nigel?
I just think rail's interesting, right, in that the US doesn't have a leading provider, yet it is enacting measures that target the CRC and others because of their unfair trade practices, which shows that it's not a matter of supporting a local firm. It's about supporting the right types of firms who engage here in a proper and fair way. And I think that's an example for a lot of other countries. Even if they aren't home to this particular sector, they may have firms that feed into that sector as a component supplier or industry supplier, and their role is at risk if there isn't sort of action taken against the leading providers here from China.
Yeah, absolutely. David, any thoughts before we close?
Well, now is the time. The International Energy Agency and others have said that this is, a decade of innovation to address climate. And now is the time to lay down, the regime that I mentioned that can facilitate competition to drive innovation, even as it fosters cooperation to address the problem on a global level.
Yeah, especially with big innovation areas that we need, like storage, carbon capture. There's some big challenges out there that we've got to make, massive progress in the next decade. And so if we don't get it right, we're all going to pay that price. So with that, thank you so much to everybody who tuned in. I apologize for the folks who we couldn't get the questions answered because we just ran out of time. And I want to thank my three fantastic ITIF colleagues. And if you're interested in more, all of this is on the website, and feel free to email any of us if you have questions. So thank you, and hope everybody has a good rest of the day.
Thanks, Rob.
Thank you.